Welcome back to Investing Talk Podcast.
Today we're looking at Sellas Life Sciences.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. And this is an interesting one. We're talking about a really high-risk, high-reward situation.
Yeah, that seems to be the theme here. So let's just start at the very beginning. When you look at the fundamentals, the picture is, well, it's pretty stark.
It is. Sellas is a pre-revenue oncology biotech. That means, zero product sales. Nothing. The entire investment thesis, everything, it all hangs on the success of its two main clinical assets. There's GPS and SLS 009.
Okay, so how should you, as an investor, even approach a company where the standard metrics, net margin, return on assets are all just deeply negative?
That's the right question to ask. But you have to completely pivot your analytical lens here. For a late-stage company like this, those negative numbers aren't really a sign of operational failure. They're just the cost of doing business. It's the price you pay to get to the finish line.
The cost of the research.
Exactly. The R&D. We shouldn't be judging them on current profitability because, well, there isn't any.
So we're really evaluating the potential for a massive structural shift. If these clinical programs actually work, what happens to the financial model? You mentioned operating leverage before we started. What does that mean in this context?
It's the absolute game changer. Operating leverage is the ability to generate just a huge increase in profit from a relatively small increase in revenue.
Okay.
For Sellas, their massive sunk costs are the clinical trials, all the R&D. So if the FDA gives GPS the green light, the extra cost to make and sell that drug is tiny compared to the premium price they could charge for.
So success just instantly transforms them.
Instantly. You go from zero revenue and high cost to a multi-$100 million revenue stream with fantastic margins. That transformation, that leverage, that's what everyone is betting on.
Which brings us to valuation. Because metrics like the price-to-book ratio, they look incredibly high, right? What does that high multiple actually signal to us?
It tells you the market has already priced in a lot of success. That high PB ratio isn't a mistake. It's the market explicitly saying it expects that future high-margin blockbuster revenue.
So investors are paying a premium now for that potential down the road.
Exactly, even though it hasn't happened yet.
Okay, so the entire value is resting on the science. Let's talk about that. What are the scientific pillars here?
The foundational competitive moat, their advantage, is all based on IP and clinical data, and is all targeting a very specific protein.
And that is?
It's called the Wilms tumor 1 antigen, or WT1. This thing is highly overexpressed in a lot of different cancers, but it's a really difficult target to hit effectively.
Okay, and that's where their lead candidate, GPS, comes in.
Right. GPS is what's called a peptide vaccine. It's designed to basically train your immune system to hunt down and kill any cells that have that WT1 protein on them.
And where are they positioning this in the market? Because in oncology, positioning is everything.
It's focused on a really strategic, high unmet need area, acute myeloid leukemia, or AML, specifically as a maintenance therapy after a patient has had a second complete remission.
So post-CR2, these are patients who have been through the ringer already.
Absolutely. They've survived the brutal initial rounds of chemo, but they're at an extremely high risk of the cancer coming back. There's a huge need for something to keep it at bay.
And that high unmet need, that translates directly back to the money, doesn't it?
It does. When you have a drug that's first in class, or it's for a condition with no good options, that allows for a much, much higher price if it gets approved. It's a massive opportunity.
So that's pillar number one. What about the second asset, SLS 009? This adds some crucial diversification, right?
It does. This is SLS 009, or tambiciclib. It's a differentiated CDK9 inhibitor.
Now, the CDK9 class, that's a pretty competitive space. What's the edge here? What makes this one compelling?
The main edge is its profile. The preclinical and early clinical data suggests it has significantly reduced toxicity. And importantly, it seems to have increased potency compared to other CDK9 inhibitors that have frankly struggled with safety issues.
You have to be able to hit the target hard without, destroying the patient.
That's the balance. And the evidence for that better profile, it really came out in the phase 2 trial.
Right.
In that trial, for relapsed refractory AML, a very tough patient group, SLS009, in combination with some other drugs, achieved an impressive 46% overall response rate.
And that was overall. But there's a part of that data that really gets people excited, isn't there?
There is. If you look at the cohort of patients who had only had one prior line of therapy, that response rate jumped. It went all the way up to a remarkably strong 58%.
58%. That's a huge number for patients who have already relapsed once.
It is. It suggests SLS 009 could be positioned to, leapfrog some of the current standards of care, or at least become a go-to combination drug early on.
And it's not just for AML anymore.
No. Data from ESMO 2025 showed it had potential in other areas, like T-cell malignancies. So this is starting to look less like two separate shots on goal and more like uh, a whole platform.
Okay, the science is clearly promising, but this all pivots on the biggest near-term story, which is the phase 3 REGAL trial for GPS. This is what's driving everything right now.
It's the dominant catalyst, absolutely.
Yeah.
And the trial has what's called an event-driven design.
Meaning?
It's not about waiting for a specific date on the calendar. The final analysis, when they unblind everything, that gets triggered by the 80th overall survival event.
So the 80th death in the trial population.
Exactly. And as of the last update, late December 2025, they'd crossed a huge threshold.
How close were they?
72. 72 of the 80 events had occurred. So they are right on the doorstep of the data release.
But what's really fascinating here is the timing. The events have been happening slower than the company originally expected, right?
They have, and this is the crucial part.
So why is a delay, which normally feels like a negative thing, being seen by analysts as maybe the most positive signal we've gotten so far?
This is where biotech analysis gets a little counterintuitive. If the event rate is slower than your model predicted, it suggests that patients in the trial, on average, are living longer than you assumed.
Okay.
And since the trial is still blinded, we don't know which arm is doing better. But if that survival extension is being driven by the arm getting GPS, well, that slowdown dramatically increases the probability of a positive outcome when they finally do unblind it.
So the delay itself is hinting at efficacy. Investors are basically reading the tea leaves from the trial logistics.
That's a great way to put it. And there was another layer of de-risking back in August 2025, the Independent Data Monitoring Committee, the IDMC.
Right. They recommended continuing the trial. How much weight should we really put on that? Don't they just check for major safety problems?
That is their main job, yes.
Yeah.
Safety and futility. They're looking for a signal that's so bad, or sometimes so good, that it would be unethical to continue.
So by saying continue, they're essentially saying
They're saying it's safe and that there's still a reasonable chance it could hit its endpoint. It's not a guarantee of success, but it removes a big non-efficacy risk from the table.
let's shift to the balance sheet. They're in this final sprint to the finish line. Liquidity is everything. How's their cash position looking?
They were in a pretty strong position. At the end of Q3 2025, they had about $44.3 million in cash. But the critical event happened after that, in October.
The warrant exercise. Now, retail investors often hate that. They see dilution.
And it does cause dilution, but it was a major cash injection. Those warrant exercises raised somewhere between $29 and $31 million in fresh capital.
So that brings their total cash up to around $73 million.
Roughly, yeah. About $73.4 million pro forma.
That is a significant cushion for a company this size. What does that do for their runway?
It gives them immense financial robustness. Their current ratio is great, around 8.3x. But the real story is that this financing has successfully extended their cash runway all the way through these key data readouts for both REGAL and SLS 009.
So the dilution, while maybe painful in the short term, was a strategic move to avoid having to raise money right before the big reveal.
Exactly. It's a classic trade-off. Short-term pain for long-term strategic safety. They've essentially bought themselves a clear path to the catalyst without a financing overhang.
Let's talk about how the market is reacting to all of this. The stock has been on an absolute tear.
It has. A multi-bagger return, something like 3.7 times over the past year. But the real headline is the acceleration. A surge of almost 187% in just the last month.
That kind of move isn't just organic, that's catalyst-driven.
Absolutely. And more importantly, that surge pushed the stock past a huge psychological and technical level. It broke and held above $5.
And it hadn't been above $5 in over 3 years. What does that signal to a trader? Is that the new floor?
That's exactly how technical analysis would view it. The old resistance in that $4.50 to $5 range is now seen as the new support. It reinforces this multi-year breakout narrative.
We're also seeing those classic momentum signals like the golden cross.
We are. The 50-day moving average is well above the 200-day. It's a textbook confirmation of a strong, durable uptrend. When you see that, plus the breakout, it signals significant accumulation.
So big money is flowing in.
E-money, retail money, capital is flowing in. in anticipation of this data.
And that anticipation has created a huge amount of bullish sentiment. We've seen some pretty wild speculative buyout numbers being thrown around.
Oh, yeah. The market mood is definitely bullish. You see chatter about hypothetical valuations up to, $25 billion if everything goes perfectly.
Yeah, which is extreme euphoria.
It is. It reflects a theoretical best-case M&A outcome.
Yeah.
We have to view those figures as speculative endpoints, not current reality.
But it's not just retail hype. There was a pretty big signal of confidence from inside the company, wasn't there?
Yes, and that's always crucial to watch before a big event. An insider buy. Director Catherine Bach-Kalin bought a substantial number of shares in November.
Insiders putting their own money on the line.
The market sees that as a powerful signal. It suggests management has a strong belief in a positive outcome.
Okay, we've laid out the massive upside, the momentum. But we have to circle back to the core challenge here. What's the single biggest risk an investor needs to understand?
It remains the binary clinical outcome. We have to stress this. The high valuation, the momentum, it's all built on future expectations.
So if the Regal trial misses,
A negative or even just a marginally positive result, one that doesn't quite hit the endpoint convincingly, it could destroy a substantial portion of the current stock value instantly.
because there's no revenue, no fundamental support to fall back on.
There's very little, and that timing risk is still there. The timeline for that 80th event is still open-ended. Until it's unblinded, that uncertainty creates volatility.
But the key concept here is what you'd call asymmetric exposure, right?
I think so. Success in Regal could lead to that huge re-rating, probably trigger a lot of M&A interest. But at the same time, you have the growing SLS 009 pipeline, providing a crucial second pillar.
So it's not a total one-trick pony. If GPS fails, SLS 009 still has value.
It does. It might not prevent a massive drop in the stock, but it mitigates the risk of a complete wipeout. What's fascinating here is how the clinical data, the slower death rate, is forcing the market to adjust its timeline, potentially signaling a better outcome than anyone expected. This turns the typical clinical timing risk on its head.
That's it for our look at Sellas Life Sciences. Don't forget to subscribe to Investing Talk podcast for more analysis on the companies driving tomorrow's headlines.